a nest egg there. So these policies do have a cash value buildup component to it, where you could save for your retirement or for an emergency through these life insurance policies. So that would handle that. Number two is living too long. We already know about living, having a premature death, right? Dying too young. Obviously, that life insurance policy is going to be there to take care of your family if that happens. But more importantly, I want to talk about the third one, the suffering, the medical condition that could really hamper somebody. One of the major things that people go through when they lose their house is a major medical condition, right? What happens when somebody has a major cancer, right? And you're not able to work for a year, 2 years, sometimes you'll never come back, right? After a major thing like that, or a major heart attack. Do people have 2 years or 3 years of income in their bank account? That's not really likely, right? That's not really what's happening out there. We're hoping that people have maybe 6 months as advisors. We're hoping that people have 6 months of income, saved up. But even that's hard. So what happens when you have a major heart attack or cancer or stroke? These policies allow that individual that goes through these medical conditions to tap into not just the cash value that they have built up, because that's already there for them, but they tap into the face amount of the policy. Mm-hmm. So I'll give you an example. If I had $1 million life insurance policy and I had a major heart attack, then I could request that company to accelerate. That's why it's called accelerated death benefits. I can accelerate 100,000 of my $1 million policy from day one after issue. And based on the severity of my medical condition, that company would send me a check for me to use in whatever fashion I want. It doesn't have to be for medical bills or anything like that. It could just be a replacement of my income or just regular bills and things like that. So I think that is one of the major things that we could really promote to individuals out there, because they don't know this, right? They think life insurance is just death insurance, or they could tell you, hey, I already got a policy at work, right? Or I have a policy I bought it through the internet. Well, guess what? That policy is likely not to have any of these benefits. I guarantee you the ones at work don't, okay? Mm-hmm. So I think if you haven't looked at your older policies, or if you say, I got it 5 years ago, I got it 10 years ago, you really need to contact us and offer, and ask for a review of that policy to see if it's still something that is something that's going to be a benefit to you. Mm-hmm. With all these benefits, I think you might want to look at maybe updating that policy. I always like to tell people, do you have the old kind of policy or the new kind of policy? And they always ask, well, what are you talking about, Will? Well, the old one only pays you once you die, and the new one pays you if you become disabled, if you become critically ill, if you have chronic illness, if you have a terminal illness, if you live too long. All of these different things all wrapped up into one policy, whereas typically you would have to buy so many different policies to take care of one problem, right? I know that the audience out there has heard of a company called Aflac, right? That's a worksite benefit. And Aflac has policies that cover cancer. They have different ones that cover stroke and heart attack and all these different things and accidents on the workplace. Well, if you start getting all of these little bitsy policies, right, to cover all these things, you're looking at 5-6 policies plus a life insurance plus a retirement. Now you're talking about 8-9 different policies to cover what one could do, all wrapped up into one. And I think that is probably the most exciting piece of life insurance at this moment. is to encounter those people that think that they're covered and they think they have what they need because they have life insurance at work, and you get to show them and say, hey, listen, this is just death insurance, and I don't want this to happen to you, but there's so many different things that can happen to you. Why don't we cover all of those things all wrapped up into one policy?
That makes a lot of sense. That makes a lot of sense. Now let's go back to something that you said, which is, I mean, definitely true. Premature death. I mean, it's unexpected. And I just got a notice the other day about an artist, singing artist that were a good friend of some other artists that I've interviewed. And at a very early age, and I'm not exactly sure how old she was, but I saw a picture and it looked like she was in her 30s that passed away a few days ago. And you know how young people are. They think they're going to live forever. They're not going to get old. They're not going to get sick or anything like that. What do you say to young people who say, "Oh no, I don't want an insurance." Now I walked into a someone's office one day. This was several years ago, and I walked right out. And I'm gonna tell you why. I walked in. I was talking to this guy that was behind the counter, and I believe he was one of the co-owners. And I was talking to him about insurance, the benefits of it. He said, "Oh man, no, not interested. I'm never going to die." So I walked right out. I said, "Now, how do you have a conversation with someone like this? Perhaps I should." It was, I don't know, his attitude, And so I sometimes when you have an orders, and sometimes when you don't. But this was one of these situations where I said, "No, I'm not going to even waste my time. Let me go next door." But anyway, and let's talk about living too long and also major medical conditions. Something that a couple of things. Living too long. Wow. A lot of people say, "Hey, what's wrong with that? What's wrong with?" But you just pointed out so eloquently what is the problem. Nobody wants to die. Most people don't want to die early, and they don't want to. Man, look, I want to live a long life. I want to live until I'm 100 years old. And I want you to talk about it a little bit again. And you mentioned it. Uh, uh, what are you going to do for an income when you're 100 years old? Have you used all of your 401k? Have you spent all the money that you had in the bank? And things of that nature. So let's talk about this a little bit and a little bit more detail on how people can provide for that. And the policies that will allow you to do that, like whole life insurance. We know we have universal life insurance. We know we have variable universal life insurance. And we also have index universal life insurance. So when you sit down to talk to a client, what are the types of questions you ask them to find out which one of those policies will suit them?
Yes, absolutely. Well, what we typically do, what a good advisor would do, is actually meet with that client and ask them questions, right? Ask them what it is that they want their financial picture to look like, right?
Great question.
You just mentioned 4 or 5 different policies, and one of the first questions when people find out what I do for a living is, which one's the best one? Which was the best one? Is it? I heard this one is bad and this one is good, and I heard what was that lady that had that radio show? I forgot her name. What was? I can't remember her, but the one that was always against whole life and
right. I know exactly who you're talking about.
Oh yeah. Okay, yeah.
Oh boy, I can see her face. It'll come to me in a little bit.
Susan Orman.
That's right.
Susie Orman, right?
Susan Orman, yeah.
She was always against permanent life insurance and only term. I'm okay with whatever out there, right? Because I know that each financial vehicle, whether it be term, universal, whole life, there's an audience for it. It was built because there's a need out there, right? So our role is to find out what that need is and to see what product fits that need the best, right? So for me, a young married couple or a younger person that doesn't have a lot of income, is just kind of starting, there is a place for term insurance, especially here. You have young kids that are still, below 18. You might want to look at having that bigger financial burden because they're depending on your income for a set amount of years, right? So to answer your question, which one's the best or what, I don't know. I don't know until I really get in there and start talking to that person, to that business owner, to that married couple, to see what their budget is, because it always has to be affordable. That's one of the things that a lot of advisors don't do right, is to really figure out what it is that they can afford for their financial future. Because you could make all these plans and, hey, this plan is going to do this, and that, but it's just too expensive for them, or it's out of their budget. As soon as they hit a little bump in the road with their financials, they start dropping all the policies, right? Or they stop dropping the retirement plan. So we want to make sure that it is within their budget, or at least find the money, right? Find maybe something that they're not really utilizing, certain funds, and direct them towards their financial future. Mm-hmm. So yeah, definitely the products are all out there. There's not one that I would say, hey, this one's better than the other. It just really depends on that individual situation. And that's our role.
Right.
Is to really figure that out. And how do we make use of what they've earmarked for their financial future? How do we stretch that dollar out?
Absolutely. And that's the value of doing fact finding.
Yeah.
Sitting down, we talked about this we talk about this all the time. Like a lot of agents will come to your house, and the first thing let's say you invited them in because you say, well, I'm interested in life insurance. First thing you do is pull out an application without asking the first question. And a lot of times the agent will take over and sell. They decline what the agent wants to sell them, which is the absolute. And I'm sure everyone on this panel would disagree with that. You sit down, and as a good agent would sit down, they want to know who, what, where, when, why, and how. Why do you want this? What is the need that you see? What do you foresee? What would your future picture look like financially? And also, if something were to happen to you, what would be the state of your family if you are no longer here? And then another thing I want to ask you, Will, I want you to talk about the importance of getting a permanent policy for your child. Now, when it comes, I know term has its uses for certain things. Like sometimes a buy-sell agreement, that's a good idea for that for the particular clients that you're speaking to, but also for children. This is one thing that I'm adamant about, and I refuse to. I will not sell a couple, and let's say they have underage children, or they even had teenage children. I will not sell a term policy or write a term policy for that child. Do you agree with that?
Yeah. In most cases, absolutely. I love children having permanent policies. I believe that one of the benefits, and going back to, I think, a previous comment that you had said, when you're talking to younger people, right, that think they're going to live forever and they're perfectly healthy, they don't need anything. Well, one of the things about life insurance that people don't understand, or maybe they haven't really thought it through, is that when the moment that people actually want life insurance, you know when that is?
When they need it.
When they need it, right? Okay. And when do they need it?
Oh, when there's health declining.
When they got bad news, right? When they get the bad news,
yes,
that something is terribly wrong. A major heart attack, a cancer, a stroke, an accident, something like that. I get calls and say, "Hey, Will, I want to bump up my life insurance. I want to do this. I want to do that. I know that you do this, and can I get it?" And I said, "Well, yeah. I talked to you years ago. How come you didn't?" Well, I got, I was told I got this thing now. And unfortunately, when you want it because you need it, you can't get it.
You can't get it.
Is the problem, right?
Right.
So to answer your question, why would a young person or why would a child want that permanent policy, or why is it a good idea, is because you are protecting your good health. You get these policies when you can qualify for them. Once
That's right.
you can qualify for them, if you have a major heart attack today, you're going to have to wait probably over 5 to 7 years before you're able to qualify again. And
Right.
that's no additional issues, right? You had a heart attack. There's this big long waiting period for companies to kind of see how you're going to react to it. And it's just not going to work, right? So with a child, because we know that most of them are perfectly healthy, you can insure them today, no problem. Usually they're issued in less than a week, and you're protecting their health. As soon as something happens, they're 18, they have a major car accident, they're not insurable anymore, right? They can't function. They lost, whatever medical issue that they have, you're protecting that. So for a young person, definitely when they're healthy, and I mean that's a better rating when they're healthy, right? And
That's right. And it's cheaper.
It's cheaper, right? And then also, like you mentioned, for these children, the sooner you get involved with these, the more time you're allowing for it to build up to that cash value, right? Where it's something that is something that is actually worth something, right? Mm-hmm. So the earlier you can start with these programs, the longer you have. So it's not necessarily always how much money you're putting into them. A lot of it is how long are you going to be putting into it, right? The length of time. Yeah. So yes, absolutely, I agree with you. I loved permanent policies on children.
Absolutely. I tell you, and the younger they are, the better off. And you mentioned something about the living benefits of that. You think about this, you get a nice policy on your child at the age of, right after they're born, 1, 2 years old. Can you and you have a really nice size policy? Okay. And also when we talk about nice size policy, it depends on your budget, what you can afford. We don't want to sell you something or offer you something that you can't afford. And later on you say, man, I can't afford this. And you end up dropping it. So you want to make sure that is within their budget to be able to hold on to it. It's not a temporary thing for us when we do this. I get a pleasure out of people saying, I want to get a policy for my child. How old is your child? 2 or 3? 2, 3, 4? Oh, absolutely. You've done yourself a favor. You've done that child a favor. And think about this: when that child goes to college, if it's a nice size policy, guess what? That could help with tuition or books or whatever, lodging or whatever it is. And let's say they keep it even beyond that, then, hey, it might be a good down payment for their first home. So there's so many living benefits. Or say they get laid off to work and they go into a rough snag or whatever, they can borrow from that policy. They can borrow from that policy tax free. Aaron, I'm gonna let you jump in a little bit. I've been kind of hogging.
No. Hey, you know what? I'm listening to you guys because I'm the newbie here, and just like Oscar, I've been writing notes. Really, I've been writing notes and just listening. So I'm gonna jump in with this. We talking about the living benefits, and you made mention of certain things, and I even heard of people, starting businesses, having the cash to start businesses, with the policies. And, we had different fun facts about that. Like the Rockefellers did it, many, many years ago. But just in my short time in this career, I've met several people who use their whole life policies to start businesses.
Will, you can jump in right off this. I'm going to tell you a true story that happens. I have a client right now that lives in Lake Arrowhead, California. Lake Arrowhead, California. And he owns a real estate company. And if you know anything about Lake Arrowhead, the weather changes so much. It can be snowing up in Lake Arrowhead and Big Bear. Big Bear, you guys, most people have heard of Big Bear because that's a great, great snow resorts up there. But he owned a real estate company in Lake Arrowhead. And like I said, it's a seasonal type of thing. So sometimes the cash is flowing in and sometimes, it kind of dries up a little bit. So he'll call me. He says, William, oh, by the way, he has 5. I said 5. 1, 2, 3, 4, 5 $1 million whole life policies.
Wow.
5.
Wow.
He has He has one on his son, one on his daughter, one on his wife, and two on himself. So he'll call up and say, hey, I need $25,000. And in a few days, he'll have a check for $25,000. So, yeah, some people start their businesses, and we'll jump in with this, and some people maintain their businesses with that. So, and that, again, that's another great living benefit. Will?
Yeah, absolutely. I think one of the advantages of the cash value products is that the money is not specified for a specific reason. And what I mean by that is, most of us that have a job at a company, they'll offer us a 401k, a 403b, these types of retirement programs, and we're funding those programs, but those funds are specifically for retirement, specifically for once we leave that company, we're age 59 and a half. Now we can start taking it out, right? So what happens if there's an emergency and you need funds, or you're talking about college or a wedding or buying a house? You can't use those funds because you're going to get taxed and penalized for using those 401k funds, right?
That's right.
Yes.
If you were, some people say, well, I want to save money for my kids' education, right? When they go to college. Well, there's these college plans called a 529 plan.
I'm glad you brought that up.
Those are great, right? But those are specifically for college. Those funds have to be used for college. So it's not that I'm against a 529 plan, but I like my clients having flexibility. And I don't know if that child is going to go to college. 1, 2, maybe they're super smart and they're super talented and they get scholarships and never have to use those funds. So now you have a bucket of money that you need to use for education and you can't use it. Now you're going to get hit with a bunch of taxes and penalties for not using it that way. Life insurance, the cash value life insurance products, they don't ask you questions. They're not going to say, hey, Aaron, why are you using this money? No, right. You're saying, I need this money. I need $20,000 from my policy. And there's no questions on what are you going to use it for? Or you have to use it for this, or you have to use it for that. Well, send me $20,000 because I want to do this. And there's no questions asked.
Right.
You're just the money. So it's a multi-purpose bucket of money. And I think that's one of the advantages of life insurance, right? That it's not taxable. You can take some of this money, if done correctly, in a form of a loan, and there's no tax consequence, where almost in every other financial vehicle, there is some type of tax consequence.
Excellent example.
And also, you have the choice of paying it back. The choice.
Yep.
Yeah. You don't have to. Now that's going to reduce your face value.
Your face value, yeah.
But you don't have to. Yeah. Another thing. Let me go back on 529. I remember when it first came out. I believe they came out in the year 2000. I believe around 2000. They came out some 20 years ago. 23. 24 years ago. 24 years ago, 23 years ago, something of that nature. And one drawback that I see on a 529 plan, I look at how it's invested, and it is tied to the stock market. There's no guarantees. Well, correct me if I'm wrong. There's no guarantees on a 529 plan. If it tanks, then you've lost your money. But not so with a permanent life insurance, especially whole life insurance. Okay, am I correct on that?
Yeah. A 529 plan has different options, right? To invest in, they have
you do.
portfolio. You choose what you want. There's some that are a little bit riskier than others, and there's some that are no risk, but you also with no risk, there's no reward, right? So
that's it.
You could ask for one of those funds, but you're not going to be making very much on it, and that's not the purpose. The purpose is to really grow that fund, right, for it. The other thing about that 529 plan is that once the child is a junior and they have to start applying for FISA, right? For their financial aid. And that has to do a lot with the parents. And one of the questions on that application is, do you have a 529 plan or do you have a college fund? And once you put that in, those funds are there. Guess what? You're not going to be getting very much because unfortunately that person did the right thing, save the money, but now you're going to get really penalized, right?
Penalized for it.
Yeah, you're going to get penalized for it. Now, when you have a life insurance, that's not specific to education, right? It's an asset. Right. Absolutely, it's an asset, but it's not gonna penalize that individual on that application. So,
right.
I've seen a lot of people liquidate their 529 plans and start putting it into different funds, putting it into the Roth IRAs. They're unfortunately have to, pay the penalties for doing that. But they are starting to do some of that stuff.
Absolutely. Yeah, I remember I've sold a few 529 plans. Luckily, it worked out for my clients, and after the children got older, they were able to use that, and I was very happy about that. What else would you want to share us about living benefits? Because I want to move on to annuities, and especially the benefits of a index annuity, a fixed indexed annuity. I want you to break it down on that. I know you're one of the experts on that as well. So what else would you like to say about living benefits before we move on?
Yeah, I think with the living benefits, what I, if I had to leave a last message on it is, if you could handle all of these different problems that we've been discussing, right? With one premium, with one policy, why wouldn't you do it? Right?
Wow.
If you start looking at how many different policies, I need a retirement plan, I need a life insurance plan, I need cancer insurance from Aflac, I need a heart attack, I need an accidental policy, I need a hospital policy, I need a disability policy. I just named you almost 8-9 policies that I would have to get. And each one of those has a specific cost to it. You start adding that up, it becomes it's unaffordable for the average American. It's unaffordable because now you're left with a choice, right? You're saying, I need all these 10 policies. I can't afford all 10. I'll choose the cancer one because I've had some cancer in my family. I'll choose a retirement. And I'll choose the accidental.
Okay.
So you're protecting 3 of the 10 things that could happen. And what if none of those 3 things happened? It was one of the 7 that you didn't cover.
Right.
So fortunately, you lose. You might lose your house. You might lose everything that you worked for. It's all gone. Now, where can we go to where it's one policy that covers all of these different 10 things? Right, for one premium to keep it affordable for people. That's why people have to call you guys and talk about these situations and say, do you have the old kind of life insurance that only pays you once you die, or do you have the new kind of life insurance that pays you if you die, if you live too long, or if you become disabled or have a major medical issue? Which one do you have? And if you have the old kind, or if you have only stuff at work, you need to really sit down with an advisor so that they can guide you on how best to allocate the funds that you earmarked for your financial future. And we can do better than the old style, right? The old style.
Absolutely.
Where you have to die.
Yeah, I'm
get some benefit.
I'm actually use that, so I don't have to pay you to use that statement because I'm gonna use that. So I'm writing it down, so I'm gonna use that. So do I have to pay you, Will?
No, that's a free. Me and William go back at least 15 years. So
man, yeah. So that's a freebie. That's a freebie, Aaron. Okay. No, very good. No, thank you so much, man. I couldn't have said it better, Will. I could not have said it better. Do you have the old policy or do you have the new? Okay. What policies do you think that you're going to need in your life? Well, I'm gonna need counsel. I'm gonna need this. I'm gonna need that. I'm gonna need, and then, well, how would you like to? Well, let's talk about the expense. What is that going to cost you? Okay. Now, what if you could handle all those things with just one policy that's affordable? I think that makes a lot of sense to me. Well, brilliant, brilliant, man. We're gonna move on, but you're gonna have to come back.
Definitely.
I know I had to drag Will kicking and screaming, Aaron, to come
No,
on. I
no,
was kicking and screaming. Oh
no.
yeah, I said no, you too good, man. He was
Yeah.
saying, no, man. Look, you guys can.
I was kicking and screaming. I will tell you this: when William first started Studio W, I was at that initial meeting because me and him were good friends and partners. Not in the radio station, but in other businesses. And he was like, "Will, I love radio. This is the future. Internet radio." And I had no idea what he was talking about. And he even he didn't force me, but he suggested to help him out with some radio shows. I even had a reggae radio show.
Sure did.
10
years ago from Studio W called, I think it was called Stir It Up. And it was enjoyable, but it's been about, I don't know, 10 years.
10 years.
Oh, wow.
When this first started. So haven't done any radio or anything like this for about 10 years. So you did have to drag me into this, but
I sure did. I had to rope time into this one.
Yeah,
He also also participated in the World on Finance show that I started back then as well.
Oh,
Yep.
Yes, absolutely.
So it was Will and Will, the World of Finance. I remember that. Absolutely.
I love it.
Oh boy, I think this is a message to you, Will. That's okay, Will. I'm gonna drag WB on our show, Kicking and Screaming on Saturday. That's my son. He does a sports show every Saturday on the show, and I started the Studio W Sports page. Okay, and then after my son took it over, I just kind of laid back. I said, "Oh man, you go for it." And so I'm rarely on now. So that's what he's talking about. He's going to have to drag me kicking and screaming on Saturday. But anyway, let's switch it up a little bit because I really want to get into tell us because you have vast knowledge about this. One of the products that I love as far as annuities is concerned, and also there are a lot of people that have addressed concerns about annuities. And so, Will, I want you to put that one to bed about why they shouldn't be concerned, especially with some of these policies out here now, especially with the IULs. We want to talk about no fees and things of that nature, but I'm not going to steal the thunder there. Will, talk to us about the safety and most of these annuities, especially when it comes to an FIA. I'm sorry, FIA, fixed index annuity.
Yeah, absolutely. Well, really, there are so many different companies and different products that are out there. It could get really convoluted, right? But our job as advisors is to really find out what the best company is for you. So there's a thing called the strength of the company, right? So it's not just, an annuity. That's not just something that it's on its own. It's a name of a product, but there's a company behind it, right? So how strong is that company that's behind it? How long have they been in business? What are their ratings? What cash do they have in hand? What assets do they have under management? All of these things is our job to make sure that this company is going to outlive our client, right? That's really what we want to look at is figure out what company is going to outlive our client, so that there's no, that concern is not there. So the strength of the company is always something that I always look for, right? Some of the lower rated companies, they might give the client a little bit more incentive, right? Maybe a little bit more bonus here or a little bit better rates here, but they're giving it for a reason, right? It's just like with anything. If somebody is, selling something at a huge discount, there's probably a reason why, right? It's not a
Right.
reference name. It's not a great product. The product's only going to be around for 2 years. There's so many different things. So definitely that's one of the things that I would say, as far as the safety of the product, right? Two, absolutely. One of the things that I think a lot of people make a mistake on is they save for retirement, right? You work and you save and you have these 403Bs and 401Ks. But the last piece of that is you've done a good job in saving, but now there's the second piece is how do I utilize that money? How do I use that money to make sure that it actually does what I need it to do, right? So that is probably the piece that most people don't do. They save, right? They put into the 401k, the company matched, and then now I got this big bucket of money. What do I do? There's, that they don't seek advice for that. And I think that's one of the major problems is utilizing retirement funds in a non-efficient way. Because guess what? That 401k money, every dollar that's in there, is it taxable or non-taxable?
Right.
It's taxable, right?
Taxable, yeah.
It came out pre-tax from your paycheck every week or every month, and then the company matched it, and it grew tax-free. Now you have this big bucket of money. All of it is taxable. So so you can't just say, oh yeah, I got 500,000 in there. I got $1 million in there. Send me a check. That's a major problem because your tax rate now for that year is going to balloon, right?
Through the roof.
Yeah.
It's going to go through the roof. So one of the things that these annuities can do when properly implemented is to plan out a lifetime income, right? Because we already talked about, you can't take these big, huge chunks of 401k money. You want to take it systematically. So one, it lasts forever, right? It lasts all of your life. And two, you don't get hit with a big tax liability for any one particular year.
That's right.
That is one of the reasons why people look towards annuities, because they're saying, here's my money. What I want is a steady flow of income that's going to sustain me and provide me the type of life that I want for the rest of my life, guaranteed. And it's not going to stop at age 80. It's not going to stop at age 85 because that individual does not know how long they're going to live. So that is one of the major things that I think annuities is something that the banker can never do. William Aaron, I'm telling you right now, a banker will never be able to promise that person. If an individual said, "Hey, I don't even want to say the name, but just any old bank, here's my 401k. Can you provide me a income for the rest of my life that I cannot outlive? And it doesn't matter if I live to 120, but I want that same money every month in my bank account." The answer is they cannot do it.
Can't do it.
Nope.
It's impossible because that's more of the insurance part of an annuity. It's not the banker. All he can do is give you a rate of return, and then you can take it out from there. But once you start taking money out, that asset starts depleting. And every time you take more money out, there's less of you're taking it out of a lesser amount, right? But with these annuities, you're guaranteeing that lifetime income. And that is huge. This is why one of the major things that I can tell you about these annuities is that, there was a big shift years ago in the United States where companies were stopped providing pension plans and moved towards a 401k.
Right.
Why did they do that? Well, the pension plan was very expensive because they didn't know how long that person was going to live. and with medical advancements and things like that, people are living longer, right?
Yep.
So they'd rather say, I don't want to do that because I don't know if this person's going to live another 30 years and I don't want to provide that income for 30 years. I'd rather just give them this big bucket of money and have them go on their way. So what an annuity can do is convert that back into a pension, right?
Mhm.
Getting that 401k money, converting it back into a pension to where there's an income for the rest of their life that they cannot outlive, and they never, well, and this is the most important part, they'll never become a burden to anybody else in their family, in their church, or anything else. They will not become a financial burden to anybody. And that is what brings financial security. That's what gives you peace of mind that you worked hard all of these years. I don't want to make a mistake at the end of how I utilize this money. You need to talk to somebody to help you with that piece.
Absolutely. That's well said. Well, another thing that you said, and I want the audience to really pay attention to this. You got $1 million and you make the mistake of telling them to send you a check. Okay. That's going to, like Will said, it's going to throw your tax responsibility through the roof. Because right now you just jumped from maybe an 18% tax bracket up to a 25 or 30% tax bracket. Well, do the math. 30% of $1 million is $300,000. Is that about $300,000?
Yeah,
Something.
roughly.
It's an enormous amount of money.
Yeah.
An enormous amount of money. And you'll never get a chance to use that money versus in an annuity where they are sparsing it out. You're getting an income for the rest of your life. And then there's less taxes on that because you're taking a smaller amount, aren't you? And plus, you will never outlive that money. And most policies there, let's say you have a guaranteed lifetime income. Now, correct me if I'm wrong. If something happens to you and there's a balance left in that account, that goes to your beneficiaries, doesn't it?
Absolutely. Yeah.
Absolutely.
In there, that's one of the misconceptions, right? I believe even before I got into the business, there was some annuities that once you annuitized it, and let's just say you only lived a year or 2 years, you only got a couple of the funds back. It was all gone. The company kept.
That's exactly right.
And that's what I'm saying. The insurance business and these companies have evolved, right? They're moving. These products are not built like that anymore. If there's a balance, it goes to the beneficiary.
Absolutely.
So we don't deal with those type of old products that the company ends up winning, right? Because you might end up a loser because you didn't, unfortunately you didn't live long enough to utilize all those funds that you had already built in there. But we don't offer those products. That's not really what we're looking for. What we're looking for is to convert these 401k monies into a pension, to have them in a safe, secure place to where the potential to get a better rate of return traditionally than the bank can give you, something that's going to keep you ahead of inflation. I know inflation right now is a little out of control and out of whack right now, but traditionally, you're looking at 2 or 3% inflation. You want to have a product that's going to get you somewhere above that, because if
that's
you're
right.
at that or below that, your buying power is going to decrease.
Yeah,
so
that's right.
Where can you look at and say, I need something that's more than 2 or 3%. I don't want to take a risk, but I want to hit that 4, 5, 6, 7% to where I'm beating out inflation. I'm still growing my money, but I'm risking nothing, because at that time, at retirement age, that person does not have another 30, 40 years to build it back up if they lose it, right?
Right.
That's one of the things that these annuities is going to provide, is that sometimes zero, I don't know if you heard this, but zero is your hero sometimes. Zero is the worst that person can do, a 0% interest.
Right.
but most cases, we have these positive gains, and it's going to be above the inflation number. So that is something that the banker will never be able to promise you or do.
Absolutely. We've got a couple of minutes. Of one other thing I want you to cover, and let's talk when we talk about safety and some of the, especially the products that I know you and I and sell and Aaron is about to sell. One thing, they use what they call sub accounts, but also these annuities we talk about have guarantees. Meaning, if the market goes up, you will capture some of the gains, but if it goes down, you do not lose. Let's say you got $1 million in there, and the market crashes tomorrow. You still have your $1 million. Now, also, when the market goes up, it automatically locks itself in every year. Well, could you take the next couple of minutes and elaborate on that?
Absolutely. These annuities have if there's one that's called a fixed annuity, where it's just a fixed amount of interest rate.
Right.
So that's one choice, right? There's the indexed fixed annuity where these companies have different sub accounts, like you were talking about. Some accounts might be a Barclays. It could be a Goldman Sachs. It could be a BlackRock. It could be a S&P 500. They all have their own different different investment strategies to them. So that's one of the things that advisors will help you kind of determine is what, every year, what should I invest this money into? But you touched on a very important point. And the important point is this: it's called an annual reset. That annual reset is so important because if you, Aaron, for example, had a 401k and you're putting money into the S&P 500, let's just say you started that January 1st and you go one calendar year and now you're up 10%, January 1st of 2025, right? Well, if that next month it goes down, guess what happened to all the gains that you had done for that whole year? They're gone.
Bye-bye.
Because there's no annual reset. With these products, what happens is, same case scenario. If January 1st we started and that whole year, calendar year went through, now you're at the first year anniversary and that product gains 8%. Well, that is your new baseline. Now you're at, if you started off at 100,000, now you're at 108. That's your new baseline. You can't lose that 8,000 that you had just won for that year. Right. The worst that could happen the following year is the market has a negative return, and all you're going to see is a zero there, right? That's why I mentioned sometimes zero is your hero. When the market is bad, the worst you can do is zero, and then you go again. The next year you had zero. The second year, now again because of the annual reset, now you're still 108, and now you're going again for that annual year. That is something that's another huge benefit that nobody else can guarantee you. There's no stockbroker that can do it. There's no mutual fund that can do it, that can guarantee and say, hey, you have an annual reset for your gains. When you are in the market, any of your gains are always exposed at any moment. So you might have done well for the first 5 years, and guess what? The market crashed and you had a bad 2 months, and all those 5 years of gains are out the door.
Out the door.
Research. So again, those funds that, again, it's so important to plan out after you built up this nest egg, in how to utilize it, right? How to strategically do that without taking risk, and also to put the liability on these strong financial companies. You're putting the risk on them, and they're guaranteeing you that return.
Absolutely. Man, I can't believe we're out of time. Will, man, brilliant as usual, brother. You've got to come back, man. I can't believe how this hour has gone by. We're a little gone by this quickly. Will, thank you, my brother, as usual. I told you, Aaron, this man's a wealth of knowledge, and that's why we had him on. Thank you so much, Will.
Definitely.
Aaron, thank you.
Thank you, guys.
And ladies and gentlemen, I have to get ready for the Groove Swing Speak Show. Now I'm coming up in about 13 minutes. So, guys, I'll talk to you later and enjoy your Tuesday and keep it locked right here on the Buzz.